Welcome. My name is Paul Mitchell. I'm a professor of agriculture and applied economics at the University of Wisconsin-Madison and extension state specialist in cropping systems and environmental management. I'm also director of the Rank Agribusiness Institute. I'm recording this video as part of the 2021 Wisconsin Agricultural Outlook Forum. The topic is farm income, the situation for 2020 and the outlook for 2021. What I'd like to do is begin with looking at where prices were happening here at the beginning of the 2020 year. As COVID became more apparent, prices began to decline. And this is shown here. These data are, this figure is from John Newton at the American Farm Bureau, chief economist. What he's done is taken the near futures prices as sort of a good estimate of spot prices nationally and showing how they relate as a percentage to the price at the beginning of the year. And what you see here is the early on, they're fairly flat, trading sideways, but quickly, as soon as the extent of the pandemic became more and more apparent, they began to decline. And by mid-April, they were kind of reached bottom for a lot of these commodities. Class 3 milk was really at a low about mid to late April. Same with hogs, a lot of other ones. And, in that early May, they were in pretty rough shape. It looked like there were some major concerns about how the farm sector was going to get through some of this economic disruption as a result of the coronavirus pandemic. Nevertheless, by the end of the year, this has now come out in December of 2020. This is USDA's estimate of net farm income and net cash farm income. What you see is they're really up. The dashed lines are the long run averages for the last 20 years, and then 2021 there, 120 billion for almost for the net farm income, net cash income a little over 134 billion dollars. These are fairly high relative to where they've been in the past. They're back almost to the days of the big commodity price boom we saw early in the 20 teens at 2012, 13, 14. Some of those years we had some pretty high incomes. And so what happened here? How did we get this much recovery if these prices falling? Well, a couple things. Again, this figure is from data from John Newton. What you see here is that prices have really begun to recover by late summer and early fall, and actually end of the year, this ends here in early December, actually recovered. We saw soybeans up by 35%, class 3 milk up by 38%, and you can see the other ones at lower levels, even hogs that are up at 5%. And that's part of it is the recovery of prices. And then the major part is really the two programs, CFAP-1 and CFAP-2, the Coronavirus Food Assistance Program. The first version came out earlier in the year and covered some of these, the remaining inventory of the 2019. And then CFAP-2 covered the period of planted acres for crops into 2020 and then production in later months. So in terms of actual amount of spending, it's an unprecedented level. This figure here plots direct government support all the way back from 1933 to the 2020 year. And you can see the level, these are all nominal dollars, but still $46.5 billion. It's more than double what it was last year, and it's well above anything we've seen in the past. 70% of this payments have been through the CFAP program, with the other ones captured in the ad hoc market facilitation program payments. Some of them came in 2020, but then the more traditional farm bill programs like ARC PLC and the dairy margin coverage, as well as conservation programs, those all only account for 30%. The majority of this payment was all as a response to the coronavirus pandemic. This is a little busy, but this is from the USDA dashboard looking at where this money went to under CFAP-1 on the left and CFAP-2 on the right for Wisconsin only. You can see the links there for the dashboards, but it really dominated the payments to our major four commodities. Dairy, beef, corn, and soybeans are our top four commodities. Dairy received the largest amount of payments, and then corn at $215 million, then cattle and soybeans. But between the two programs, the CFAP-1, 2, over $1 billion of payments were made to farmers. And on top of that, it was over $110 million for ARC PLC and DMC for our farm bill programs. So there's been a tremendous flow of capital into the state as part of these coronavirus response. You can see the number of farmers receiving payments is almost 25,000 by CFAP-2. CFAP-1 is still almost 19,000. So a lot of farmers and a lot of commodities were impacted. But again, the primary focus was on our major commodities, milk, beef, corn, and soybeans. Net farm income, both with and without farm payments here, or government payments, are laid out in this figure. back from year 2000 on, the blue line shows net farm income total, which includes both government payments and commodity sales. And if without just commodity sales, we would have been at 73 billion in 2020, below our long run average of net farm income. But you can really see that large gap, how it really increased this year. The gap between the red and the blue lines shows how much more the coronavirus food assistance program, the CFAP payments, really increased that net farm income as response to the income losses we were seeing with the price declines in those early parts of the year. Now, looking at the production year, we luckily dodged any bullets. I think about Iowa and the derecho and how bad that was in August. I think about how bad the wet weather we had in 2019. If we'd been hit anything like that in 2019 with the wet year and all the prevented plant or the derecho here in Wisconsin, it would have been a major disruption. In general, these maps or these figures can be seen show the planting progress. We'll look at some other ones. But with the read them horizontally. The dashed line is 2019, the dotted line is the 5-year average, and then the solid line is for 2020. And you look at like 50% planting on corn there, and the first figure on the bottom left shows it happened about in maybe May 27th, 28th last year in 2019. The 5-year average is somewhere around May 12th, maybe 13th. And last year for the 2020 crop year, we were at least about a week or more ahead of that. And that happened corn and soybeans. We were always a week and a half ahead of where we were on the 5-year average. And the 2019 year was probably a couple weeks late. So we were much quicker progress on planting. You saw this with emergence, with tasseling and flowering and all the other crop stages. And overall, in general, the weather was great for Wisconsin. This is the percent of corn acres and soybean acres on the right in good to excellent condition throughout the cropping year. The dotted line is the 2019, the dashed line is the 5-year average, and then 2020 at top there in solid. You can see the state was usually 85% of our corn and soybean acres were in good to excellent condition, above our usual level at the 5-year average and way above where we were last year. So we had a great production year. This is the percent of our acres in excellent condition throughout the season, anywhere from 25 to almost 40%. And we led the nation. All of the other states are plotted in the same data for all the rest of the year there. And you can see all the states, Wisconsin was the top in terms of percent of our acres that were in excellent condition. Minnesota would be second there. So we had a great production year. And then it comes to harvest time. Again, it was very delayed last year, but this year, ahead of schedule. Early on, it was about right on schedule, but then the last half of the crop came out fairly quickly, about a week ahead of time, what would be a normal 5-year average. Yields were good, 174 for corn and 51 for soybeans. These are just announced in mid-January. These are both the second highest in the state history. They're lower than we anticipated earlier. USDA had some higher expectations last year, back in December and earlier. And I think we just figured out that there was a little dry at the end of the year. We weren't sure how much crop that loss that caused. It took a few bushels off in some of our crops, I think. And then I think, to be honest, I think our soils were somewhat damaged by all the wet weather we had the years before and all the need to try to plant and harvest and do machinery operations. And I think we're recovering from some of the wet weather we had in 2019, but even years before that. Nevertheless, we had a great crop year. And now thinking back, we had the 2019 crop and then the 2020 crop. Both of those are marketed during the 2020 calendar year. And what you see here now are cash receipts. This would be price times yield or production sold during the calendar year, and looking for our major commodities here in Wisconsin. And what you see is these are the national numbers, but they'll very much mimic Wisconsin. Dairy, our number one commodity, essentially no change from 2019. Beef, our number two commodity, down about 6% because a lot of farmers were selling cattle during that period, March, April, May, and all those months when prices were collapsing relative to earlier levels. And we were unsure what was going to happen. So farmers sold their animals. It's also time for them to be sold. Corn's down about 5% for the same reason. There's sales going on during those low period times. Soybeans, there's some sales in those low period times. We had this particularly high run up in soybeans faster. And soybeans have definitely been a major source, an increase in cash revenue for farmers here in the state and nationally. So you can see across these, we're probably going to be about the same in terms of cash receipts for the year for 2020. costs are down. Slightly, that trend has really been, there's been a lot of downward pressure on costs here in the ag sector, a lot of thin and tight margins, and so there hasn't been a lot of upward pressure. Interest rates have been low, fertilizer costs have been flat. The only really upward pressure we're seeing is things like in labor. There's a lot of labor shortages for a lot of industries, and ag is no exception. And I expect those costs to continue to go up into 2021. Fuel prices are showing some upward pressure here in 2021 already, and that might continue. Whereas interest rates will stay low and even lower than they were in 2020 potentially. And we've seen a little upward pressure on rent, but nothing tremendous. $1 an acre at the state average. So we haven't seen a lot of upward pressure on many of our costs at all. Maybe some of this extra capital that's flowing in will put some willingness to spend and bid up some prices on some inputs. But I don't see a tremendous amount of cost inflation for 2021 at this time. Here's the cropland values. This is the USDA NASS data, came out in early August of 2020. And you see the Wisconsin has a slight decline in land values. This is cropland values, very similar to what you see around states around us. Minnesota down a tiny bit, Michigan down a tiny bit, Iowa down about the same as us, no change in Illinois and Indiana, and Ohio up a tiny bit. You can see that's pretty much the Wisconsin's in the norm there. A little probably flat is what I'd call it more than anything. It's just a small variation up or down. Then you look at this one. This just came out in October now, and this is several months or a few months later, and it's also good farmland, not just all farmland. And you can see the Federal Reserve System here out of Kansas City's Fed, and some of the same data quoted also out of Chicago Fed, shows probably a 2 to 3% increase in land values in the state relative to a year ago. This would be late in the calendar year of 2020. And I think that's just part of it's the good farmland. And I think good farmland is still the value, and people see a return there. And the other thing I think is there's a lot of that. We saw that big influx of capital, and part of what some people were doing is using it to buy land, bid up land prices a tiny bit in their communities when the pieces became available. Delinquency rates. This again is Federal Reserve data. This is from the St. Louis Fed, but it's released at the national level as well. This is be all farmland loans and all non-real estate loans, all ag loans. These are at all kinds of banks. And what you see there is the delinquency rate it's flattening out. It's been slowly creeping up after these several years of tight margins. But you can see late in 2020, the farmland loan, the land mortgages have flattened out. And even looks like the rate of increase might be slowing on the non-real estate loans. This is some interesting data as well. This is, again, out of the Kansas City Fed, and this is looking at loan balances at commercial banks. They actually declined 8% in 2020. We'll look at the left-hand side figure here first. The solid line shows the farm debt outstanding at commercial banks. And you see the total is actually negative. It decreased. There's a percentage decrease, which is, fits the heading there at the top. But that last time this happened was in the late 80s. And so that shows you how unusual this is. Even the big price, commodity price boom we had in the teens, 12, 13, 14, those years, that would only hit about zero, no change. So I'm not sure what's going on there. This is at commercial banks, and I think I can think of various factors, but one is they're using their CFAP payments to pay down their debt to the point of actually decreasing their need for ag lending. The other possibility is there's a movement into non-traditional, non-commercial banks lending, maybe using some of the input suppliers or other informal lines of credit, or at least not commercial banks. On the figure, switching to the right side, what you see is that there's another trend that's happening there at the commercial lending to these banks. They've been pulling back at the small banks. And I'm not sure. Are they just using their CFAP payments and other, increased money to pay down those loans? And that's why the debt at small ag banks with less than $200 million worth of assets, is that why those banks, their farm credit portfolio shrank because they're just paying it down? And is it up at the big banks because are they just paying their debts down, or are they moving to those bigger banks or into non-formal lines of credit? I'm not sure. But you can see there's definitely, we've seen this is the first time in several years where these ag banks saw a decline in their the amount of money held at farm debt. And that's an unusual trend. It bears watching to see if it's just a one-time issue as a result of the coronavirus pandemic and the government payments, or if there's something longer term going on there. A sign of good news here is the Wisconsin dairy farm attrition rate. This is the loss rate, or the number of farms exiting the industry, has declined back to almost its traditional long-term rate of about 4%. What these are is the state of Wisconsin, well, the USDA NASA summarizes these data. It's the number of dairy herds each month in the state. And you can see for 2015, 16, and even the first half of 2017, the annual decline in that rate was up in that number of herds is about 4% a year would exit the industry. And that really started to accelerate beginning in the middle of 2017. It kept going up. By the late 2019, it was over 10%. And even early 2020, it was over 10%. And it's really had a rapid decline. In December here of 2020, it was down below, actually by January, it was down below 5%. So we're getting really close to our long-term rate, or standard rate of about 4%. So that's a good sign that that consolidation that was accelerating is back to more standard levels. However, we still are leading the nation in farm bankruptcies. There's still a lot of financial stress out there. I think not all farms are participating in this boom. And all these CFAP payments, there's plenty of information to show that not all farms get these payments. And what you see here is there's still a lot of financial stress. Wisconsin's leading the nation. Not all farms are participating in this boom, basically. And then this is a sign, this isn't all farm bankruptcies aren't filed under Chapter 12. And so there's even more out there. And not all farms file bankruptcy. Some just reorganize, pay off their debt, and maybe exit the industry, just don't declare bankruptcy. But there's been still a decline in the number of farms. And this farm bankruptcy, this is a sign that there's something going on here. And we're losing a lot of farms here at a rate much higher than the rest of the nation. So our coronavirus pandemic dominated the ag and farm news. There's lots of support for agriculture. It came in financially at unprecedented levels. A lot of people were concerned about the levels of the disruptions that were happening, the price collapses that seemed to be occurring in the markets. And so Congress and the administration responded. The ag industry has given back. There's lots of evidence of that in terms of donations of food banks and such. There's been a huge run on food banks in the country, and agriculture has been part of that, helping out, making donations. In general, farm income was up in 2020, and it looks like it'll be pretty solid in 2021. The price outlook looks positive. We'll hear that from the other speakers. There's lots of signs of strength for the ag sector and the aggregate level. Prices are looking better, and the costs are generally flat. The loan delinquency rates seem to be leveling out or flattening out. Loan balances are actually declining. I'm not sure that's a withdrawing of credit or just paying down their debts. Land values are up or flat, depending on what kind of the data you look at, but it looks like there's no, the farm land value is holding or even increasing. And our rate of exit from the dairy industry is stabilized. It's almost back to its normal rate of about 4% per year. But however, there are some farmers being left behind. Farm bankruptcies are still up in the state, or still high, I should say. And there's a lot of data to show that the state of Wisconsin here has had a major jump in food, people receiving SNAP benefits, supplemental nutrition assistance. It used to be called the food stamp program. And there's definitely a lot of COVID impacts, with 400,000 people officially dying as a result of the pandemic, and several thousand here in the state of Wisconsin. It's pretty much left almost none of us untouched. And I think there's a lot of financial stress still in some parts of the farm economy. And of course, all the emotional stress that's affecting a lot of us as a result of the shutdowns, and then the overall just the response and the pandemic in general. So thank you for your attention, and we'll look forward to seeing you at the 2021 Wisconsin Agricultural Outlook Forum. Thank you.